Hello, everybody. Thank you for joining us on our first webinar for the Wealth Horizons by Team LWC series. Want to get started right away just to be respectful of everybody's time because we've got a lot to cover today. For anybody who doesn't know me, my name is Mitchell Shields. I'm the in-house financial planner for Team LWC, and today for our first webinar of my Wealth Horizon series, we're going to be focusing on individual pension plans. You may have seen recently I did a paper on individual pension plans, which I'm going to make sure to send out to everybody. It was more of a deep dive into how to think about the individual pension plan as a part of our overall financial strategy. But today I wanted to do this live presentation just to provide a little bit more context and a little bit of an overview to the plan as a whole, to get your mind thinking about whether or not it might make sense for you, or if you're an advisor to professionals, whether it be a tax advisor, legal advisor, or what have you, whether or not this might be a good fit for your clients. So we're going to dive right into it. We've got a lot to cover in a brief amount of time. Like I said, I really want to respect everybody's time. I'm going to try to keep things tight to 45 minutes, maybe a little bit shorter than that if possible. With that said, I'm not going to be having a live question and answer period for this session today, but I will follow up with everybody who was in attendance to see if there was any questions that may have come up from the conversation. So without any further ado, I'm going to dive into things here, starting with, well, what is an individual pension plan? Throughout the session, you may hear me refer to it as an IPP as well. So in short, an individual pension plan is a defined benefit pension. So we all heard of defined benefit pensions. Typically, we hear about it for, teachers' pensions, government pensions and what have you. But the individual pension plan is a defined benefit pension that can be set up for business owners or incorporated professionals, or in some cases, executives of incorporated businesses. Typically, these plans are designed for, one employee, in some cases up to 4 employees, but these would not be common in an environment where a defined benefit pension plan was set up for all of the employees of a business. This is really designed more for the owners of the business. And like I said, a lot of the times we'll see that with professionals who have professional corporations and things of that nature. So there always has to be a connected employee as part of the plan. So a connected employee is defined as an employee who owns over 10% or more of the sponsoring corporation, right? So in most cases, with a partnership style arrangement, each one of the connected employees would have their own individual pension plan that was set up. However, it is possible to add others to the pension plan who would not be connected employees. This is more common when we're thinking about adding family members who might work in the business. So as a defined benefit pension, the IPP gives us a guaranteed retirement benefit that we can expect. Essentially, this is the promise of a retirement income that's being provided by our employer, our sponsored corporation. And in order to fund that promise, the corporation would need to put money into the pension plan that would be sufficient to fund that future promise of a lifetime income in retirement. So I include this table here. This comes from a company called GBL, who is an actuary firm that specializes in individual pension plans and a few other plans as well, just to show that when it comes to the contributions into the individual pension plan versus, an RSP, which many of us might be using for our retirement planning at this point, the IPP can provide some additional benefit when it comes to the amount that can be put into the plan on an annual basis. So I'm going to touch more on that as we go through the conversation today, and how that might be a benefit to the overall your overall financial plan. So it's also worth noting that the IPP is not, it's not ideal for everybody. It really needs to be considered as part of the overall financial plan. It can't be looked at in a vacuum. But if we were to give kind of like the typical client base that it might make sense for, or kind of the initial triggers where you might think it's worth looking at. We're typically looking for, again, connected employees. So individuals who own over 10% of a corporation. Typically in your mid 40s is where you start to see that, the present value of that promise of that retirement income promise being above what you could get into in an RSP, as far as the RSP deduction limit every single year. So typically mid 40s is when we start to look at this. And you typically want high T4 earners. You typically want people who are earning enough salary income where they're earning above the maximum amount to contribute into things like an RSP. Now, that one I also kind of add an asterisk to, because low T4 earners can be well suited for a pension plan, but typically that's going to be when they have had a long history with that company. Where that comes up most common is farming families, where, you may have started working at, your dad's farm, your mom and dad's farm when you were 16 years old and started to earn a salary and worked that farm your whole life. So in cases like that, it very well might make sense as well. And I'm going to cover that when I get into the valuation metrics that go into calculating the amount that can be put in. So the IPP is similar in some ways to the registered retirement savings plan, as it allows you to accumulate assets for retirement and invest those assets, and it gives you a deduction when you make those contributions. However, with the IPP, as I've already touched on, typically those deductions are quite a bit higher, and there are some other potential tax benefits and some other negative considerations that we need to look at as well. So one of the key differences between the IPP and the RSP is, with the IPP, the contributions are made at the corporate level. And they're made from the corporation for the benefit of the plan member, the member of that pension plan. Unlike an RSP, where that money would need to first be paid out to the shareholder, and then the RSP contribution would be made at an individual level and deducted at an individual level. So it bypasses, when we're making the IPP contribution, it bypasses going through a payroll system. It goes directly into the pension plan and provides a deduction at the corporate level. In addition to making that corporate deduction, so having that deduction at the corporate level, the corporation is also able to deduct several of the fees involved with an individual pension plan. So some of the key fees is actuary fees. So I'm going to touch on this shortly. We would need actuary support with these plans, and the actuary would charge a fee for that. That fee is deductible at a corporate level. Any financing costs, so if it is suitable, it's deemed suitable to take out a loan to make an IPP contribution by the corporation, those financing costs could be deductible. And another big difference versus the RSP is the investment management fees can also be deducted, which cannot be done with an RSP. So there are some additional deduction benefits to some of the fees involved with the IPP above and beyond what we can do with the RSP plan. Now, on the flip side, unlike the RSP, the money is locked in until retirement. In one way or another, and that can be seen as a positive for a behavioral perspective, but that can also be seen as a negative, where we have less liquidity, less access to those funds than if we were in a pinch and we needed to access those RSP funds. That could be quite a bit easier on a personal basis. Now, another thing to understand about an IPP is it's not actually an account of the corporation. It would be considered a trust arrangement unless you're utilizing segregated funds. I'm not going to dive into that for the purpose of our conversation today. I touch on it a little bit in the article, but it's a little beyond the scope of what I want to address today. Since it's not considered an asset of the corporation, it does have protection from creditors as long as it was not used specifically to defraud creditors. So in that case, there is similar protection as well to utilizing an RSP, but as a pension, as a trust, it is creditor protected. Also, as a trust, there is a requirement to file T3 pension reports, and that must be done by March 31st. Now, for any accountants in attendance, typically that is handled by the actuary firm, so that would not be an additional requirement on the accountant's workload. And there is the additional cost that goes into managing this IPP versus a traditional retirement plan. As I already touched on, we would involve actuary support. So when the plan is first being established, we would contract an actuary firm to make the calculations around, what pension promise the shareholder would be eligible for and how much the initial funding would be. Typically, you're going to see a fee somewhere around $2,500 to do that initial assessment, just depending on the actuary firm and the date that you contract them. Ongoing, there is going to be an ongoing cost as well. So, typically that's going to be somewhere around $1,500 a year that you would have as an ongoing cost to the actuary firm to continue to provide actuary support on an ongoing basis. That fee, again, is deductible. And when we're looking at the overall deduction limit versus an RSP, we in most cases immediately will make that back in tax benefits. But it is one of the things that needs to be considered in a cost benefit analysis when determining if we should implement a plan like this. And yeah, so it's as I was kind of just touching on there. Perfect. So let's get into the weeds a little bit. Let's get into the valuation metrics. So as a pension plan, there is a maximum funding amount that can be made into this plan. So when we're designing a pension, the government's not going to just let us build as big of a pension as we want. There are maximum funding valuations, which would be similar to a typical defined benefit pension. But some of the additional kind of key valuation metrics I've highlighted on this slide. So one of the key valuation metrics that goes into managing the individual pension plan is there's an assumed rate of return of 7.5% on an annual basis on the investments within the plan. Now that provides some great benefit over, looking at an RSP as our primary investing vehicle, because if we have some negative years in the portfolio of investments within the individual pension plan, or we have some years that lag under that 7.5%, on a triannual basis, so every 3 years, the actuary firm is going to do a recalculation to determine if there's a triannual amount that can be added into the pension if it's underfunded. And part of the underfunding is going to come from the realized rate of return versus the assumed 7.5. So if we've underperformed, that would allow an additional contribution to be made, which would allow us to pull some more money out of the corporation. Now, some would look at that as an opportunity if we need to strip funds out of the corporation to artificially lower the rate of return in order to provide larger contribution amounts. So, think about investing in money market investments, T-bills, GICs, earning a very low rate of return intentionally. That would allow us to add more to the plan on a triannual basis and strip more out of the corporation. But I always want to caution the core purpose of this plan is to save for retirement, and missing out on key years of compounding interest with the sole intention of being able to strip some more funds out of the corporation may be short-sighted. And we need to make sure that we're not letting the tax tail wag the dog when we're looking at this. And in some cases, if the rate of return is above that 7.5%, when we come to the triannual calculation, we may have to reduce the contributions on the next, on the next few years if the plan was overfunded. And one of the other things that needs to be considered in this, I'll caution that this is different. This is different based on your jurisdiction, based on the province that you're in. For our purposes, I'm going to speak to Ontario's rules. In some cases, it may not be optimal to make a contribution. Recently, Ontario allowed the underfunding of these pensions as long as it's for connected employees. So when we're looking at an individual pension plan, if we determine that for one reason or another, it's not optimal for us to make the contribution, we can skip those contributions and allow the plan to be underfunded. That is, of course, not permitted when it comes to a traditional defined benefit pension, because we're saving for others' retirements and the corporation has given that promise. But when we're saving for our own, several jurisdictions have allowed for the underfunding to take place. And in years like we think 2020 with COVID lockdowns, having that cash on hand may have been very valuable, and it may have made sense to skip that. Two other key valuation metrics that come into calculating the pension amount would be the inflation rate. So the calculation is going to assume a 4% rate of inflation within its calculations. And it's also going to assume a 5.5% annual increase in salary. So this is where, I want to bring us back to that farming family example, because if you were a child and you were brought into the farm early on in life and took over the farm, became a shareholder later in life, you have a long track record of T4 income from that corporation. If we're starting early on in your life, 16, 17, 18 years old, and assuming that your salary increased by 5.5% per year, you very well might become a prime candidate for these individual pension plans as well, even if you're not a high T4 income earner at this time. So let's talk a little bit about initial funding. So let's say we've looked at the individual pension plan. We've determined that we think it would make sense. We've run some quotes with an actuary and determined we want to implement this strategy. How does this get funded initially? So initially, the actuaries are going to make an initial funding assessment and determine, based on how long you've been part of this corporation, how much should you have been putting into this pension plan above and beyond what you had been putting into your RSPs from the time that you had started your employment. So in most cases, especially if we're later 40s, early 50s, and we're starting to look at these strategies, there would be a large amount of initial funding that could be done, and income, and that amount of money could be pulled right out of the corporation and into the pension plan right off the bat. As part of that, a portion of your personal RSPs will be required to be moved to the individual pension plan. This is part of a past service pension adjustment calculation. So this is effectively saying that for those earlier years that you were contributing into your RSP, you should have been contributing into this pension. So we're going to need to move X amount of dollars from your RSP to your pension that should have otherwise been in your pension. Now, for your earlier years, when you were younger and working within this business, you likely would have had a higher RSP contribution amount than amount that could have went into the individual pension plan. So you would typically be left with an RSP balance afterwards. It would typically just be a chunk of the RSPs that would need to be moved into the individual pension plan. Now, that doesn't mean that you can't move all of your RSP into your individual pension plan. And a lot of the times that does make quite a bit of sense. In addition to the past service adjustment that would need to be done, moving the RSP, the mandatory portion, you can make an additional voluntary contribution of your remaining RSP funds, which would be moved into a sub account within your pension plan. And this would allow us to share in some of those previous benefits we talked about, whether it be the deductible nature of the investment management fees. Well, that would be typically one of the big benefits, is getting those management fees deductible, which would not be available in the RSP. And it also just reduces the amount of accounts that your retirement vehicle we're saving for retirement. So what happens when we retire? What are our options? The first option is we take the pension plan. Right. So when we determine that we're going to be retiring, we're going to be turning on the pension, we bring the actuaries back to the table and they do what's called a terminal contribution calculation, and to determine, based on the initial promise, the amount that should be promised, based on any additional benefits such as indexing to the amount of the pension, any survivor's benefit to a spouse. Based on all that, what is the present value of that promise today? How much needs to be in the IPP in order to fund that promise? And if at the time it is found that the IPP is underfunded, we get basically one more kick at the can and make a withdrawal out of the corporation into the IPP to make that contribution. Now, that the IPP can be turned on as early as 55, or we can defer it as late as 71. But the first option is to turn on the pension. The other option that we could look at, which I don't think gets looked at too often, is we could look at something called a copycat annuity. Essentially, we're just still taking the pension, but instead we're transferring the amount that's in the IPP over to an insurance company and purchasing a life annuity. So this is effectively passing the risk from our personal investment accounts to the insurance company, and they're the ones who are managing that promise. Now, if the annuitant passes away early in life, there may be some losses to the estate. And we also need to be cautious of, if the CRA determines that the copycat annuity is materially different than the initial pension. That can get a little bit complicated in nature, but in short, we just want to make sure that the copycat annuity would not be better for the shareholder than taking the pension, or there may be some repercussions from the CRA for a tax perspective. And the third option is to collapse the plan and take the payout. Now, this would not typically be the approach, especially with an individual pension plan. I think we see this very often with other defined benefit pension plans, probably inappropriately in a lot of cases, but we could collapse the plan, take the funds back out personally, and contribute those amounts into a locked-in account, or in some jurisdictions back into an RSP. But there would be a large chunk of that amount, if assuming we were funding the IPP fully, there'd be a large taxable hit in that year, which would negate a good amount of why we had originally put the individual pension plan in place in the first place. So that would not typically be the recommended approach. So what about inside of the individual pension plans? What can we invest in within the plan? So eligible investments within the individual pension plan, so much like our RSP tax-free savings accounts or brokerage accounts, we can invest in most asset classes within the IPP that we could invest in within the RSP. So stocks, bonds, mutual funds, exchange traded funds, whatever the case may be. The one exception, kind of the big exception, would be shares of the sponsor company. So we couldn't hold shares of the parent company within the pension plan. There are also some diversification rules stipulated within the legislation, which would state that no one position could make up more than 10% of the portfolio total. Something to understand, though, when we're looking at it from a practical basis, is the pension regulators are not monitoring how the pension fund is invested. So since the plan beneficiary, the person the plan is for the benefit of, is typically also the trustee of the plan, and the trustee would have a fiduciary duty to the beneficiary. And if it's the same person, it would be very unlikely that that person would take themselves, file a breach against themselves. So in practice, that is not, the 10% diversification rule is less of a true concern. Now, when we're talking about the tax benefits, we've layered a good amount of this already through the session, but one of the key benefits right off the bat is, again, the deductibility of the contributions into the plan. This also helps the corporation reduce retained earnings within the corporation that might taint things like the small business deduction limit. It may also help with the corporation when it comes to things like the tax on split income rules, where if this was not implemented, the shareholder would have to bonus more income out to themselves, since it's not as easy to split income with a spouse as it once was. On a personal taxation level, when the contributions are made into the individual pension plan, the shareholder receives a pension adjustment, which would allow them to reduce their taxes personally, much like if they had contributed into an RSP. When it comes to the calculations, the shareholder would typically end up with a $600 amount that could be added to the RSP every year. So it has effectively wiped out any future RSP contributions that could be made. I would say the one place that this might need to be looked at as a potential concern is if it made sense to contribute funds into a spousal RSP, where we're putting that money to the name of our spouse, and when it comes out in their hands, but we get the deduction. That would not be possible with the IPP, because we'd only be able to really put about $600 a year into that spousal RSP. Now, the IPP would be splittable. So when the pension income starts, we'd be able to split that with the spouse, and that could happen as early as 55 as its pension income, where with an RSP, that would start at 65. But if it did make sense to have all of the income come out in the spouse's hands, it may not make sense to go down the IPP route. And in addition, so just my last comment there, in addition, when the income is realized, since it's pension income, you would be eligible for the pension tax credit. So if it was being split with the spouse, you would both be eligible for that tax credit as well. Well, what happens now if we sell our business? So if you sell the business, typically the acquirer of the business is not going to want the liability. So we can go back to our, what do we do when we turn on the plan? If we're selling our business and it has an IPP in place, we are likely over the age of 55. One of our options is we can just turn on the pension. Right. And that would allow us to make that terminal contribution and pull some funds out of the corporation before we make the sale. But if we're not ready to sell or turn on the pension, we do have an option, and this involves some pre-planning to do a sponsor change to a holding corporation. So if you have a holding corporation where you're holding your operating business shares either wholly or partially by that holding corporation, in some cases we would be able to transfer the plan to the holding corporation to remain the sponsor. And that holding corporation can technically continue to make the triannual contributions. However, with a holding corporation, it'd be unlikely that there'd be active business income that we'd be looking to deduct against. So that very well might not make sense and is beyond the scope of what I'm hoping to accomplish in the conversation today. Now, what happens if we pass away? So with the individual pension plan, much like an RSP, one of the things that we're able to do is we're able to name a beneficiary of the plan. Now, in Ontario specifically, this can be done through the will. This is going to be a little bit different on a jurisdiction to jurisdiction basis. So I'm speaking primarily from the background of Ontario. So we can name the beneficiary. Now, unlike the RSP, that amount could be taxed in the hands of the beneficiary. When we pass away with our RSP, 100% of that amount is added to our terminal tax return in the year that we pass away. With the IPP, this can be passed to the beneficiary, which could reduce the taxes owed when it comes to the taxes at death. Also, if this was a family business, so if there were other adult children who were involved in the business and were added to the plan, the assets can remain in the plan for the benefit of the future, for the additional shareholders, for the children, which would allow us to continue to defer some taxes for our next generation. Now, what happens if I leave Canada? So I think this is, I've noticed this is a conversation that's coming up quite a bit more with our clients. What happens if we leave Canada? A lot of people are realizing that with kind of the modernization of the world, we don't necessarily have to retire in Canada just because we've lived here and worked here. So the IPP can be a great complement for those who are looking to retire abroad. One of the main benefits right off the bat is when you sever your ties to Canada, there would be something called departure tax that you would have to pay. And the individual pension plan is not caught in that calculation. So the individual pension plan you would not owe departure taxes on. Where the value of your corporate shares, you would. So by moving some of these retained earnings from the corporation to the individual pension plan, you could reduce your tax liability on the departure tax. In addition, when the withdrawals are made from the IPP, it's going to be based on the tax treaty between Canada and your new country of residence. So in most cases, when people are moving abroad, they're moving into countries that have lower income tax brackets or potentially no income tax when it comes to pension income. And in Canada, in most tax treaties, Canada is typically going to take a 15% tax on that income. So by moving abroad, we could, out of this pension plan, realize a tax rate on the income of 15%, which makes it a great complement to somebody who's thinking that they might retire abroad at some point in the future. So looking at the time, looks like we ran a little bit over, but like I said at the forefront of the conversation, I really wanted to give an overview of the individual pension plan. I think I've shown that this is an involved plan. There's lots of nuances, and I went into more detail on the document that I had written up, which I'm going to circulate with everybody who's in attendance as well, in addition to the recording of this conversation. But I wanted to give kind of a brief overview on all of the main points of the individual pension plan and give you start to get your thoughts moving around whether or not this makes sense for yourself, or as I said at the beginning, if you're an advisor to clients, whether or not it makes sense for some of your clients. And hopefully I've given a little bit more confidence around the strategy to be able to discuss it. If there's any questions, I'm going to shoot an email out to everybody in attendance with all my contact details, and just to ask if there was any questions based on the session. Please shoot those to me in an email. Happy to book a conversation with you as well if you'd like to spend a little bit more time on this. And I greatly appreciate everybody taking some time out of their day to join me on this session. I hope it was very valuable. And this will be the beginning of an ongoing series of webinars that we plan to provide on financial planning and tax topics, in addition to our already regular monthly webinar on investment topics. So again, my name is Mitchell Shields. I'm the financial planner with Team LWC, and I really appreciate you taking some time with me today.